Sophie Frampton. I'm here with Helen Todd from Britannia and Pippa Atkins from our Lockton PL London office. So we're here today to talk about this year's Lockton Market Report, the P&I report, and the state of the P&I market in general. So just to talk a little bit about this year's Lockton P&I report. So we've really changed it up this year, which hopefully by now you've all seen. So instead of it being a static display, it'll be constantly updated as we hear the general increase announcements and as we move through the renewal. So make sure that you stay tuned when we release our renewal updates as they come through. So are we ready? Should we talk about this year's report?
Yeah, and may I just say congratulations on a super report. It is really easy to navigate and to read, and it looks beautiful as well. So well done. I know a lot of hard work's gone into that. It's great.
Thank you. I'm so pleased to hear that. We really tried to make it useful to the user this year, and our marketing team spent a lot of time choosing those visuals. Okay. So we've talked in the report quite a bit about last year's results, but if we start talking a little bit about the underwriting results, so from our calculations, we know that 2024 saw an overall market underwriting loss of about 312 million. We sort of discussed some of the possible causes of that. Poor claims being something that's been discussed quite a lot.
Yeah, we've that's widely reported, obviously, but pool claims in 2024 have gone right back to the very, very high levels that we saw in 2019 and 2020 after a couple of very benign pool years. So that's obviously affected the entire P&I market. I can only speak for Britannia as well, but in addition to the very high pool claims, we personally saw our own retained claims hitting historical highs in terms of number and severity of claims. It's really difficult to say exactly why that was, because we've done a deep dive into our own retained losses. We had quite a number of expensive elisions, and they were much the higher end than we've seen historically, but we couldn't find any particular patterns to those. And we have done deep dives. It could be a number of things. The international group as a whole are now seeing larger, more complex ships coming into the fleet. You've got mega container ships, large car carriers, and LNG dual fuel ships carrying significantly higher asset and cargo values. So when something goes wrong, like a fire or a collision, an elision, a grounding, total liabilities and losses do seriously escalate. I think that has had an impact.
And do you think it's possibly a combination of all of the factors that we're seeing all at once? So it's completely random, fortuitous, and it's that pool has had a bad year, retained claims have had a bad year, like the combination of inflation, geopolitics, everything's combined to make it extra bad, if you like.
Yeah, I would definitely agree with that. I mean, claims cost inflation, we all see that medical and personal injury settlements are much higher now than they ever have been before, as well as legal fees and experts' costs. So everything is just costing more. And I think you're absolutely right, Pippa. It's a whole, it's not any one thing, and it is quite random. That's something that we've said quite publicly as well. Our 2024 year we've seen as a very bad year, but a random bad year. It's not something that we are, or we're hopeful actually that doesn't continue as it has before. And actually, we've still got a way to go with the 2025 years. But claims for us, at least, seem to be much more in level with previous years, and in line with our projections.
It's not a new paradigm. We've heard that not so much this year, but a couple of years ago when there was really bad pool year, we heard that it was a new paradigm and this was the new normal. And then that kind of swiftly, when there were no pool claims the following year, people stopped talking about that quite quickly.
I don't know. It's my personal opinion that it was the benign years were actually the unusual years, and I do think that the higher pool claims are here to stay, because of the larger, more complex shifts that we're coming on, because of inflation, because of legal, environmental, and societal pressures. I mean, we see certain authorities demanding, kind of zero tolerance remediation on certain pollution matters, and that's going to drive costs up. All of those things, it does lead to uncertainty, but I think the pool, unfortunately, will continue to stay quite high. But I think when you're looking at each individual club's own retained claims, that's something that the clubs themselves should be able to manage through their underwriting.
Yeah. I suppose if they are the drivers of higher pool claims, that they're not trends that are going away anywhere. So we can assume that that's the new norm, if that's the phrase. Yeah. And I think from what we're hearing anecdotally, you're right in the retained claims. Different conversations with different clubs at the moment do sound like there's different patterns this year across the clubs, which I suppose talks to the randomness of claims in that level, that some years are good and some years are bad.
Absolutely. It's not a new thing that P&I and mutual P&I is volatile. You're going to have some good years and some bad years, and that's why we all exist. Owners have claims and we're here to pay them, but it's volatility is a key word that we hear bandied around all the time, but it absolutely is a volatile market. And obviously you've got long tail natured claims as well.
Do you think that, jumping around a bit, but do you think that the clubs that have diversified, having that little group of clubs, do you think they're having a different experience? Is that something that you've looked at Britannia? Do you think that has an impact? Or do you think some years you just have, we've also heard that, some years it balances out. So you have a good year on the Hull, you have a bad year on the P&I, and then sometimes it all comes home to roost at the same time.
It's diversification obviously is something it's difficult for me to comment on as being part of a club that isn't diversified in that sense. I don't think diversification is inherently good or bad. I think it's good if it's strategic, contained, and there's transparency around it. But obviously, usually, as you were saying, you might have one line of business that's doing well and then props up the P&I and vice versa. So, as long as diversification reinforces a club's financial resilience and adds member value, and there's an underwriting discipline there rather than chasing down external profits, I think it's a good thing. But as far as Britannia is concerned, really, we remember that we're the oldest P&I club in the group, and clubs at their core were founded as mutuals to ensure third-party liability to owners. So we believe that expanding that too far can erode that mutual ethos. And of course, if diversification losses emerge, there's a perception there that playing insurer with members' capital can damage trust. So, we firmly believe that we want to be not suggesting that diversified clubs aren't experts in P&I. Of course they are, but you can look at it both ways. But I do think it's neither good or bad. I think that it's down to the individual owners to have the choice to choose where they see the most value added.
Yeah, I think that's the crux of it, isn't it? And in some years we know that the other lines support the P&I, and some years that's not how it works out. So it's about the choice for the owners and where they want to put their P&I and their other lines and what works best for them.
And there's no doubt that sometimes in bad P&I years, other lines can pick that up, but it can have the opposite effect as well. So we just don't know. Again, it's volatility, isn't it?
Yeah. Should we talk about investment returns a little bit? So one of the things that we drew out within the report is that almost all of the clubs recovered last year's underwriting losses from their investment returns, and the market as a whole certainly did. And that investment return is clearly providing a capital boost to the clubs and supports them in both positive and negative underwriting years, because it's all capital to members if the investment returns are good.
Yeah, sure. Again, investment returns often act as that kind of second leg of financial performance. So it can smooth, as you just said, Sophie, it can smooth results and protect clubs' free reserves. So that's a positive thing, and that can enable some clubs to distribute capital back to members or to add to their free reserves. And as you correctly stated, it did offset a number of technical underwriting losses. I think obviously any P&I club, any mutual P&I club would say it's best practice to not solely rely on your investment income, particularly with the pressures of S&P. Their S&P, and as every club should be, is focused on the pure technical underwriting performance, and that includes net combined ratios and capital quality. So really, investment returns are great when the yield is good and it adds to free reserves, but they nowadays in the current regulatory environment, you just can't rely on investment returns anymore. And so every mutual P&I club's focus will be to have a balanced technical result.
Do you, with that in mind, obviously last year investment returns were good.
Mm-hmm.
How are your investment returns looking at this point in this year? And do you think that's going to be, can you rely on it to be a cushion in the same way it maybe was last year?
Yeah, I think so. To date, the investment returns are looking good. They're tracking above our long-term rate of return. Obviously, anything could happen between now and February, and I guess we've said volatility a billion times, but there is that. But at the moment, the yield is looking really, really good. And again, it could help soften that. But Britannia's focus is, and we've always said it, we've been returning capital back to the membership since 2017. So when the investment returns are good, and it's not the manager's decision, it's a board decision at our board meeting in November. But if they've been performing well, the idea is that will be distributed back to the membership. And we treat it completely separately to the actual underwriting result, and that means that even in a good investment year, when the technical result, the underwriting result is still above 100%, your break-even combined ratio, then there is a need to increase the rates.
Yeah, because we sometimes get questions about the different approaches and kind of how, to someone who's not familiar with some of that technical underwriting versus your investment accounts, we sometimes get asked why it doesn't make any sense. Why would you have a GI and then also give the same amount back or give more back or whatever? Those things don't necessarily make logical sense, but
and
it's different.
Exactly that. And we're often asked exactly the same question, but one is the capital strength of the club and how the investments and other funds are managed versus claims out and premium in. And when claims and costs have exceeded the the mutual premium in, that's something that then has to be addressed.
What do you think? I don't know if you can say this, so if you can't comment on this, that's absolutely fine. But what do you think we've obviously got, I think the first board meeting is this week maybe. What do you think the general approach to the upcoming renewal is going to be across the clubs?
Who's that to, Sophie or me?
You.
Me?
Yeah. What do you think the general?
I don't know. You're probably better placed to know. My feeling is it's going to be a very similar renewal to last year, and from things that I've heard in the market and anecdotally, I expect the range will be 5 to 10% general increases. That's not suggesting that's going to be ours. Our board meetings at the end of November so would be decided then. But I think that seems to be the mood music. And you might say arguably that it sounds quite modest. I know with every owner has increasing demands on their own OPEX and things. But actually something that came up in your review was actual general premium levels of the group and how they basically stay static despite general increases and things. And I do think that is something that we all have to think about quite carefully, because even if you're coming in at 5%, that's probably going to still keep you fairly static. Because churn is hurting. I think churn hurts all the clubs, and that's when older, higher rated tonnage is going off and being replaced with newer, much more competitively rated tonnage. And that that's something that every underwriter will have to bear in mind. And I do think there's a greater appetite for owners when they're looking at their operational expenses to look at increasing deductibles rather than to offset against any premium increases. And I think that explains why. And you highlighted it in your report, I think, so you might be able to add something more on that.
Yeah, it was actually quite an interesting point when we stopped and looked at the premium levels that had been reported over the past few years versus those general increases, because as you say, premiums are static despite that. And we sort of thought about what we're seeing ourselves with our clients, and quite often there is that trade for you take deductibles because you don't think that the claim would happen to you rather than paying the premium. So that feels from an OPEX and from an operations point of view that is sometimes favourable. But the churn effect we saw in our own data. So we record premiums and claims for all of our clients, and we've been doing it for a very long time. So we were actually able to go in and look at our own rates across our own clients and see that very same trend with churn. So And
are you seeing with your clients fleet consolidation? Because that's something that I've noticed as well, and that I think has an impact as well.
I never thought it before, but we have seen some of that even amongst our clients.
Where they decided to consolidate, give
that's a good point.
Down into maybe a fewer number of clubs. And maybe, I'm not sure why, maybe that's because there is now there are 12 international group clubs rather than 13. I think consolidation works both ways sometimes.
Yeah, maybe. And you think that sorry, go on, Pippa.
No, I was just going to say it gives you that premium volume, so then you're putting pressure on the rates
over time.
It gives you premium volume, which is great, but the rates are then coming down.
It's wiggle room.
So that could be another factor.
Not connected, so it's not. But I wanted to ask you, I heard someone say in passing the other day that in relation to 2024 pool, pretty much all of the claims had related to dry cargo vessels or car carriers or container ships.
I think it's fair to say that the most expensive claims came from those sectors, and in particular the high profile container ship losses. They weren't all of the claims. I think you're still seeing, it's probably about 75%, maybe slightly under, coming from the dry sector and container ships. But there's still a good 23, 24% coming from tankers as well.
So it's maybe the high profile ones.
The high profile, bigger severity claims, seem to be from that sector. And when you look at the claims that have been reported this year as well, they've come from the same sector to date.
Yes,
thanks.
But I wonder if how much of that is just the sort of proportions of vessels actually operating. So whether that just reflects shipping, that there's more container ships operating.
That would make sense when if you've got more container ships in the water, then proportionally there's going to be. And I wonder if maybe there's, I don't know, this is pure speculation, but and with the rise of the shadow fleet, perhaps there's less tankers in less tankers in the pool as well.
That's been talked about. Yeah, sorry, I have spoke. Yeah, that's been talked about in a few things I've been in recently, that the number of tankers now operating in the shadow fleet and removing themselves from the IG is having an impact. Yeah,
I don't know enough about it to
no,
fully, but it's supposition. But
yeah,
It would make
and
sense.
definitely hard to prove, but yeah.
I think
I think the only thing left, and it's probably in terms of, so we've talked a little bit about what we think the general increases might be, sort of projecting, or as Lockton Marine was projecting 5 to 10% across the market this year. Probably too early to say, but is there any early indications on the GXL?
yeah, I think that is really too early to say. I think it's obviously still being discussed, and there's a lot of uncertainty out there. So yeah, I'm unfortunately and not
completely
not in a comment and not in a position to comment. So sorry about that.
No problem at all. Okay, I think that brings us to a natural conclusion. So thank you, Helen, for joining us. Thank you, Pippa, for your time. And thank you to everyone for listening.
Thank you. Thanks, Sophie. Thanks, Pippa.
Bye. Bye.
Bye.